this is Don Kaufman, and you are watching the TheoTrade Weekend Update, June 3rd, 2022. Should we fear some of the market complacency that we're presently seeing on, well, much of the news that's out? We've got low volatility, we've got low skew, we've got a low VVIX. I'm going to dive into that in quite some detail. But before I do that, just a brief discussion. Have you heard some of the negative implications to this marketplace over the last 48 hours? I mean, just some wild stuff. Let's start with the fact that Elon Musk himself actually came out and discussed the economy as being, well, what he termed super bad. 10% layoffs across the board, specifically at Tesla. Tesla here with, again, just over 20 minutes left inside of the trading day, down about 9%. Then prior day to that, we had Microsoft, and well, Microsoft actually lowered guidance. I think the irony of the Microsoft announcement is that the underlying actually finished slightly higher. Again, infinite degrees of complacency. We had Janet Yellen couple of days ago come out and just say she was wrong about inflation. It was a big one, near and dear to my heart. Jamie Dimon comes out and talks about an economic hurricane. But then on top of all of it, this morning, of course, Friday morning, the jobs report comes out, non-farm payrolls, and it's good. But right now, the S&Ps are down just about 1.5%. Meanwhile, all of this is transpiring. We're thinking about complacency, but I want to put a number to complacency. And again, I want to talk about the implications of low volatility. And again, the S&Ps are down 1.5%. Where's the VIX presently? Not doing anything today. I mean, the VIX is, for the most part, it's massively unchanged with the S&Ps down 1.5%. And you have to think to yourself, it doesn't matter what your directional bias is at this point in time. You got to think to yourself, what does this market seem to know that I don't? And that's precisely what we're going to cover here in quite some detail. We're going to look at aspects like skew. And if you're unfamiliar with skew, we're going to be talking about out of the money put premium versus out of the money call premium inside of the SPX, because with a skew that is this low, it's indicative of there's just no hedging activity. Forget about retail trade on the professional side of the marketplace. The VVIX further confirms it. This is something that we picked up on a few weeks ago, but it's just hit absolutely fever pitch again in the last 48 hours, because no matter what the news cycle seems to be, the market just stares, laughs, and just keeps right on going. With that, let's get into it. Let's discuss a little bit about this complacency and, well, should we have fear surrounding it? All right, so let's start to take a bit more detailed look specifically at markets. So I was saying a moment ago, so the S&Ps are down here just about 1.5%. I mean, the Nasdaq's off 2.6%. Meanwhile, okay, the volatility, well, in my opinion, is taking an absolute dirt nap. I mean, we've seen nothing but downside activity really the last 2 weeks in terms of VIX. Now, I'm not a big VIX kind of trader. I mean, it basically just means listen, the VIX isn't telling us anything other than 30-day, implied volatility inside of the SPX. Nothing more, nothing less. I don't necessarily use it as the fear indicator. Nevertheless, I mean, when the S&Ps are down 1.5%, or, the Nasdaq at some point today faced almost a 3% loss, you would think to yourself, hey, volatility, wake up, because what it's saying is just complacency in the midst of the sell side. And it doesn't matter who you are. If you understand volatility, that just is blaring as wrong on the screen. But, VIX can't catch a bid to save its life. But I have to tell you, that's, I think, the furthest thing from my mind right now. And yeah, we're going to give you a recap of the marketplace, but seriously, push all of that stuff aside, because you have got to get through the fact that volatility is not moving, and yet the marketplace is getting whacked back here just a bit. So let's start to talk about this complacency in the midst of selling. One of the first things that I want to bring to your attention is known as skew. Now, some of you are maybe familiar with skews. I talk about skew just incessantly, but I want to bring up pretty much the full history of skew. and I'll explain it in a bit more detail. We'll get a little more graphic about this skew. So where is skew presently? All the way down here. And again, I'm highlighting it across the screen because if you look back in time, is this the lowest skew that we've seen? No. Okay, but it's unquestionably one of the lower areas that skew has been in. Okay, and one thing you can say without unequivocation, pretty much in terms of time, this is the kind of the lowest skew we've had since the onset, if you will, of like COVID. And there was a brief and fleeting moment, okay, during kind of the COVID rally back that skew got down to the 120, but it immediately rebounded. This has been quite a considerable. I mean, you're into the third week of an inherently low skew. Now, if you don't speak market geek and you have no idea what skew really is, what it means, we're actually going to cruise over here into the spiders. Yeah, skew is actually representative of the SPX, but it's just easier to interpret some stuff inside of spider. So I'm going to open up these July options and just open up a ton of strikes. And we're going to open up also what we term implied vol. So what skew really measures is way out of the money puts. And I'll give you just a quick example. These way out of the money puts, okay, these, 380, let's call it 385s, they're trading right around a 28% implied volatility. So put that up here, okay, 28% IV on the puts. All right, cool. Well, that's the out of the money puts, and then we're actually going to scroll just a little bit, and we're going to look at just way out of the money calls. I mean, at least look at some calls that have a little bit of juice in them, a little bit of premium left in them, and we'll look at something like these 446s, which let's just round it to they're about an 18%, okay, IV on the calls. So what skew really is, it's the differential between these out of the money put implied volatility and the out of the money call implied volatility. In this particular case, can't round it and be any easier. Okay, there's about a 10-point differential, right? About a 10-point differential. And you go, well, that's just wonderful, Don, but that doesn't tell me anything that I didn't already know. Well, maybe what you didn't know though is taking a look back. If you looked back maybe earlier this year, and you can actually do this on thinkorswim, and it's if you're not comfortable with thinkorswim or don't have the platform, it's fine, but for the most part you can actually go back just a few months in here and go back to like mid-February. It doesn't matter necessarily what day. You can open up similar options, 29-day time frame. Now, implied volatility can be a little bit funky when you're using things like think back, right? But when we start to open up a ton of strikes, what I want to show you here is some wildly out of the money puts. Let's say that we have, like a 31 vol of these out of the money puts. And then we go, okay, somewhat out of the money on the call side. And you're seeing here all the way to these 484s. These have about a 15 vol. So for the most part, that's almost a 15% volatility differential versus a 10-point volatility differential right now. You go, who cares? Okay, that's just wonderful, man, but who cares? It all comes down to, I'll tell you what it means. All right, it's if you didn't understand it, now you kind of have a little bit of an understanding of what that put call like differential is. It's called skew. The implications of it are simply this, right? What really drives skew, what really drives it is traders buying out of the money puts. All right, when they go out there and they buy puts. When I talk about traders, I'm not talking about, Joe sitting at home, Mr. Retail Trader over there. I'm talking about firms. They go out and they reach for puts inside of the SPX. And I have actually stood down in the SPX well after my time in Chicago, but I stood down in the SPX in a time in 2008 where traders were just in dire need of puts, and that's all that came into the pit was put buyers, and the volatility absolutely exploded. See, the fact of the matter is, no one is out there rushing the market for puts, and that has implications unto itself. So there's no fear and loathing right now, because why would they buy puts? So you turn around and you would buy puts, all right, for a couple of reasons, but hedgers buy puts because they're predominantly long stock, okay? And buying a put puts a nice floor, okay, under a long stock position. It's a type of a hedge. So if you don't own any puts and we really start to sell off, see S&Ps again, they're down, 1.6%. But if we really start to sell off, you don't have puts, what do you typically do? Okay, well, you turn around and buy them, and they buy puts. And one of the issues that I have right now is knowing that skew is inherently low leaves us in an incredibly precarious position, because should traders at this point turn around and do what? Well, if they buy puts, because what could actually transpire is, the market kind of trickled down a little bit, maybe trickle a little lower, and then all of a sudden, snap, and we actually head extraordinarily lower. Why would we snap lower? And I'm going to tell you exactly why. All right, we start to trickle down, trickle down, trickle down, and all of a sudden, traders. Okay, and this is not market makers. This could be proprietary trading firms. It could be big funds. All of a sudden, traders come out of the woodwork, realize they don't have any hedges on, and they turn around and they buy puts. As soon as the traders buy puts, what they're actually doing is, again, predominantly, they might be long stocks. They're using those puts as a hedge. All right. So long stock is what we term positive delta. Buying puts implies negative delta. Unfortunately, somebody has to sell them those puts. Who's going to sell them the puts? The MM. What's the MM? The market maker. The market maker is going to sell puts. As they sell puts, they raise up the implied volatility, charge more. Why? And markets are falling. When they sell puts, what that does to them, it makes them massively positive delta. Right? When you sell puts, it makes you positive delta. Why? Because you don't want the market to go down when you sell puts. But market makers don't care, because market makers are what they call bona fide hedgers. It has to do with the Dodd-Frank bill, specifically the Volcker rule. So they go out there and they're predominantly bona fide hedgers, which means any positive delta they add to the portfolio, they have to counteract immediately with what? With negative delta. How do they actually get negative delta? They will sell S&P futures. So this actually creates this environment that if we start to trickle lower and all of a sudden everybody realizes nobody's hedged, we snap lower. Okay, risk reward right now is not favorable. You have a tremendous amount of downside risk, expressly because, right, no one's hedging. Skew says that. The crazy thing is VVIX actually says it too. This is why I'm covering it right now, because I don't really care what you think about like your MACD and your Fibonacci and your Bollinger Band, and I'm not picking on you for any technicals. Okay, that's not my intent. But if you start taking a look at stuff called like VVIX, and VVIX are like, VVIX has no options. It shouldn't have options. VVIX. So all we have to actually understand about VVIX is the volatility of the volatility index. Where's the VVIX presently? Ooh, this is what's kind of crazy. And again, it's almost hard to explain if you've never really looked at VVIX before. You're like, whatever, man, the chart's low. So the VVIX is all the way down here at the 90 region. In fact, this is unequivocally the lowest spot that we've seen the VVIX really since you got to go back to the beginning of pre-COVID times. Again, here we are in just highlighting that. Again, we're going back into the 2020 timeframe. Again, specifically to zoom in over here, this is in just prior to COVID. Again, the VVIX down last time it was down in the 90 region. You're going all the way back to the January timeframe of 2020. So for those of you that do not speak geek and you don't really get like what is the VVIX? So it's the volatility index. What it's actually measuring in VVIX is, when traders are scared, they often go into VIX and they buy call options. You go, well, why would they buy calls? Because calls are great hedges inside of VIX if the marketplace crashes. Like if you think about this, if the S&Ps go down, VIX goes up. Okay, so they buy calls as hedges. So VVIX is actually screaming right now. What? Well, it's back to 2020 lows. So there's no hedging activity in VVIX, right? VIX can't catch a bid, low skew implications, right? VVIX, it's just a lack of hedging. And I almost feel like, well, what does this marketplace seem to know that I don't? And at this point in time, I'm going to tell you right now, that's just, the ever the skeptic in me. You're in this business long enough. You always kind of think somebody has got to know something that I don't. Again, I'll give you a summation of this. Complacency in the midst of selling. The summation of it is, I don't want you to actually use this for directional bias. Like, I don't want you to sit here and tell me, like, does this mean we're so bearish? No. What it does imply, though, to me, is that any given marketplace, and right now we're looking at the S&Ps here that are on your screen, in any given marketplace, and again, this is the S&P futures, which drive order flow to the entire marketplace, there's upside potential and then there's downside risk. At the present time, okay, there is absolutely upside potential. And I'll tell you right now, the upside potential probably somewhere around 42.11. I would have to reassess at that point, see where the market does. Okay. The problem that we have right now is I see downside risk as being absolutely phenomenally huge, because down below over here, we do actually have a gravity point. The gravity point is at 39, okay, 31. All right, so the upside we have 42.11, downside we have 39.31. But frankly speaking, I think 39.31, we breach that and we're going to be off to the races. I mean, you can actually look at the S&P is breaking, 3,700, 3,600. We'll go into a bidless beast kind of a scenario. And I don't mean that to intimidate people. I just want you to understand what I view as the implications of this complacency. And, should we actually have fear of the complacency? Yeah, why wouldn't you? I mean, if you don't have fear of the fact that why is volatility not budging with the S&Ps down 1.5%, okay? I mean, there's no easy answer for that one other than no one's engaging the marketplace right now and saying like, oh, I got to buy puts, but hedging activity should always transpire. Again, 4 minutes left inside of the trading session. Cruising down, then we're going to turn around. We're going to examine some of the asset classes. And when I say asset classes, start to look at stuff like the financials, the XLF and the XLF. And I like to look at the financials first. Take a look at auto expected move. They ended towards the lower edge of their expected move this week. I mean, they're literally like on the lower edge of the expected move. You start to look at though, implications of individual stocks. Now, this stuff starts to get a little bit deep. When I say implications of individual stocks, look, Microsoft actually rallied from the lower edge of the expected move. Okay. You start looking at stuff like Apple. And again, I am an advocate of always pulling the option chain first to look at the implied volatility before I ever even look over here. But if you take a look at Apple, it actually finished the lower edge of the expected move. So tech is right on the verge of taking a bigger hit. All right. Financials are already taking that hit. So last week, is it erased completely? No. You look at something like Apple, it's still significantly higher than last week. We start to deviate though, again, back over to the financials. Financials are only sitting at a 25 vol, even after Jamie Dimon's comments. And again, I'll reiterate something here is that we're still significantly higher than we were last week. So we're not coming in off this bounce. Then you start to look at things like metals. Okay. There's still like, when it comes to metals, forgive me, I like to pull up stuff like silver first. And the reason I like to pull up stuff like silver, it's a slightly volatile metal, or more volatile, I should say, than gold. But again, nothing going on over here. Complete and total complacency in recent trade. If anything, I'm a little bit more bullish inside of some of the metals at present time. Okay, you take a look at oil, and again, all of this adds up to the fact that we're talking about complacency. Okay, am I the only one looking at oil and thinking to themselves, $120 a barrel? Okay, because and the reason I'm actually bringing this up again, it's not to intimidate. It's actually to form, a full discussion, a full picture of what's plausible and what's actually reality in this marketplace. And oil very well into early next week could actually breach some of the recent highs. And this, okay, this isn't just a big flash in the pan. This has actually been a slow grind to the upside. We haven't even started to squeeze, if you will, into like a gamma squeeze to the upside. We're in a really, really precarious, picture over here. Again, sector ETFs starting to back off. Okay, some of that rally, they haven't completely given it back. The metals are total complacent. Oil and energy is absolutely ripping over here. Then you start looking at stuff like crypto. And by the way, lately when I've been looking at crypto, I've actually looked a lot at like the BITO chart. Okay, so when I start talking about like BITO, this is the Bitcoin ETF. You're not familiar with it. It's like 18 and change. But like BITO presents a pretty interesting case. Markets in Bitcoin specifically are actually, they're just holding on by a thread. I mean, that's the only way to present it. I can pull up actual crypto markets over on the Tasty platform, which I do from time to time. But for argument's sake, right now, though, we're just going to look at again, Bitcoin futures, as I say, holding on by a thread over here. Similar, though, to some of the metal markets that don't have, okay, a strong directional bias. Meanwhile, all of that actually kind of transpiring where you have, again, oil kind of breaking out, metals meandering, crypto meandering, but holding on by a thread near some of its lows. You get bonds, notes, rates. Okay, if you haven't looked at this, and we're actually going to pull up TNX, which is the 10-year. All right, if you're unfamiliar with the 10-year, you better get familiar with the 10-year. I'm actually trading quite a bit in terms of rates. The 10-year, once again, rapidly approaching almost the 3% level. We have interest rates once again about to ready. It looks like to break out to the upside. And again, Meanwhile, lower bonds, higher rates, that just does not look good at all for tech. I can't draw too many positive aspects from this marketplace other than the fact that it feels like the entire world right now is bearish. And again, just in there is the closing bell. Just in my opinion, when the entire world is bearish, you get that bid back to the upside. But at this point, again, you are seeing so much in terms of trade that it's not just complacency, okay? It's lack of a directional feel. It's for the most part the S&Ps, as I said, meandering right now around this, 4111 or right now, 4100 almost even. Okay, there's not a great directional bias right now, and in a time like this, even the fact that we have some lower volatility, premiums are still really good versus, all right, actual price action in the marketplace. What I'm telling you is, yes, you can still sell some premium, but I do want to give you a little bit of a cautionary tale because I did actually sell some premium today. And here's that cautionary tale on this Friday afternoon. Go at it very, very slowly. If you are going to sell premium, and again, I have no problem actually displaying a couple of positions in here, but if you're going to go at it and you're actually going to sell some premium, okay, take a very, very soft hand. This is actually one of the lightest allocations that I have had at any point this year. Okay, why? Well, it is in very large part, there's lower volatility, but it's still decent. But the skew bothers me. The VVIX bothers me. I want to go out and I want to sell premium, but at the same time, I don't want to get caught in the middle of crossfire. If, as I said, those S&Ps, there can be some phenomenal downside exposure at this point in time, not because we think we're going down. And that's one aspect, again, that I really want to resonate with you on this weekend's update. This isn't about what Don thinks. Again, everybody in the world right now seems bearish. Elon Musk has turned super bad. It was his term, not mine again. But it's not about what anybody thinks. There's a time like this, you got to block out noise. You just got to read pretty much into the marketplace. The downside risk to the marketplace is being created by the complacency. So if you look at like the low skew implications, that's why I've got fear to the downside. It's why I'm actually at a lower degree of allocation, again, than any other point year to date, and that's my TheoTheo portfolio. I'm also managing some positions over here in the Zaba portfolio, managing some positions over in the TheoTheo small portfolio. If anything, I'm grossly under allocated, and I'm comfortable being under allocated. Why? And maybe a little calm before the storm, but that's neither here nor there. Okay. Watch markets carefully. We start to slip to the downside, and acceleration could transpire. Keep yourself relatively hedged, right? If you have a strong directional bias right now, it doesn't matter whether it's bullish or bearish. Okay, take that position with spreads. Just take it with spreads because volatility is still going to be incredibly complex to be able to deal with. If the marketplace explodes to the upside, you might think, well, the VIX is going to be dropping back to 18. That could be plausible. But if the marketplace sells off a little bit, VIX could be sitting at 40, 45 in no time. Again, there is this just wild risk reward that could play out not only inside of the S&Ps, but volatility itself. Last but definitely not least, we come to the SPX, the mother of all products. So the SPX, specifically today, closes down just about 70 points. So the reason I kind of talk about the SPX on a week-to-week basis over here happens to deal with the fact that expected move for this past week, and again, this past week was a holiday trading week. We only had 4 trading sessions. We had this $100 expected move. The week before that was about $126 expected move. So this entire week we have this $100 expected move, but we just did like back-to-back days where, I mean, for the most part, yesterday had this huge range, over 100-point range just yesterday. Then today we sell back off by 70 points. Where am I going with this? Well, where I'm going with this is if you look 7 days out, and the expected move is not completely settled out, but if you look 7 days out, we only have a $104 expected move in the near term. Do not sell short dated options. I'm going to say it again. Do not sell short dated options. The implied volatility in the shorter duration looks inherently low. If you go a little further out in time, like we do with Ultima, okay, we have considerably more implied volatility. In fact, further out in time, we actually also have more skew. Be a little bit reserved in taking some of your positions, okay, until the market kind of finds its groove again. Effectively, what am I saying? Wait for some of the complacency, okay, to kind of wash out of the marketplace. Listen, if we're going to explode to the upside, so be it. I'm positioned for it. If we're going to take off to the downside, as I said, I don't have a tremendous amount of skin in the game in either direction. Right now, I'm selling both sides of the market, doing it rather small. I do actually fear some of the complacency in the marketplace, and I'm looking for that to kind of give way once again to a bit more definitive market movement this next week. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye bye.